The SP 500 is one of the best investment inventions ever created. That is the place I want to begin. Because if you do not understand that point, you will misunderstand everything else. Many people hear someone talk about beating the SP 500 and they immediately think the goal is to become clever, to become aggressive, to gamble, or to prove that the market is easy to defeat. That is not the way I think about it. The SP 500 has compounded wealth for ordinary investors for a very long time. It has survived recessions, wars, inflation shocks, banking crises, political fights, housing crashes, technology bubbles, and every kind of human fear you can imagine over long periods. It has averaged roughly 10% a year. That is extraordinary, but in investing, small differences compound into very large differences when they are given enough time. That is the first principle to understand. If you begin with $10,000 and you invest it once, and then you never add another dollar, and it compounds at 10% for 10 years, you do not become poor. You end up with roughly $26,000. That is a good result. But if that same $10,000 compounds at 13% instead of 10%, you end up with roughly $34,000. If it compounds at 15%, you end up with roughly $40,000. If it compounds at 17%, you end up near $48,000. Over 10 years, the difference is meaningful, but many people will say it is not enough to change their whole approach. That is because they are thinking in short cycles. The real power is not obvious in the first few years. The real power shows up when time stretches out and the compounding machine begins to separate the good from the very good. Over 30 years, that same $10,000 at 10% becomes roughly $174,000. At 13%, it becomes roughly $395,000. At 15%, it becomes roughly $662,000. At 17%, it becomes almost $1.1 million. Same starting money, same person, same first decision, very different ending. That is the lesson. You do not need to make ridiculous returns to change your financial life. You need a small edge, held for a long time, through a system that you can actually stay with when conditions become uncomfortable. That last part matters most because anytime you try to get more return, you must accept more risk. There is no way around that. The world does not give you higher return for free. It makes you pay for it with volatility, uncertainty, concentration, drawdowns, and the emotional pressure that comes when the thing you own falls while everyone around you tells you that you were foolish. So I do not want you to hear this as a promise. I do not want you to think there is a guaranteed fund that will beat the SP 500 forever. There is no such thing. What I want you to understand is how to think about the possibility of slightly better returns in a rational way, not by chasing random stocks, not by jumping into whatever is hot on the internet, not by trying to predict next week, but by looking at broad baskets of companies that have historically captured stronger parts of the economy and then asking yourself whether that exposure still fits the world you believe is unfolding. That is a very different thing from gambling. It is the difference between betting on noise and understanding a system. Let us begin with the foundation. The SP 500 is a group of roughly 500 of the largest companies in the United States stock market. When you buy a fund like SPY, you are not buying one company. You are buying a broad basket. You are getting exposure to companies like Apple, Microsoft, Nvidia, Amazon, Tesla, McDonald's, and hundreds of others. The beauty of that structure is that it is self-cleaning. If one company weakens and is no longer strong enough to remain inside the group, the index can remove it and replace it with a stronger company. You do not have to personally watch every balance sheet. You do not have to decide whether a struggling company still deserves a place in your life. The index does that work for you. That is why the SP 500 is such a powerful core holding for many people. It is broad, it is simple, it is inexpensive, it is tied to the productive capacity of the American economy. It has worked across many cycles, but it is not the only basket. And if you understand how baskets are constructed, you can begin to see why some funds have the potential to outperform the broader market during certain long periods. The key is not magic. The key is exposure. What are you really exposed to? What kinds of companies are inside the fund? What economic force is driving those companies? What risk are you accepting in exchange for the possibility of better returns? That is the framework. The first kind of fund to understand is an SP 500 growth fund, such as VUG. This kind of fund does not try to own every kind of company in the same way. It focuses more on the companies that are classified as growth companies. These are businesses expected to grow earnings and revenues faster than the slower, more mature parts of the market. In simple terms, it takes the broad market and tilts it toward the faster, moving companies that can be powerful. When growth is working, when capital is moving toward innovation software, digital platforms, artificial intelligence, and companies with expanding markets, this kind of tilt can perform very well. But there is a trade-off. When the economy slows, when rates rise, when investors start demanding immediate cash flow instead of future growth, those same growth companies can fall harder. The slower value companies that were removed or reduced may act like stabilizers during certain downturns. That is why you have to understand what you own. A growth fund can be an intelligent way to seek stronger returns, but it is not the same thing as the full S&P 500. It is narrower, it has a stronger bet embedded inside it. The bet is that growth companies will continue to deserve higher weight over the long term. That may be right, but it will not feel right every year. And if you cannot hold through the years when it feels wrong, you do not really own the strategy. You only own the good part of the story. The second fund to understand is XLK, the technology sector fund inside the S&P 500. This is a more concentrated idea. Instead of owning all 500 companies, it focuses on the technology companies inside the index. Over the past decade, technology has been one of the most powerful forces in the market. That is not surprising. Technology has changed how people work, buy, communicate, advertise, compute, store data, build products, and run businesses. Software has scaled with very high margins. Semiconductors became the foundation of modern computing. Cloud platforms became the operating layer of the digital economy. Artificial intelligence created a new wave of demand for processing power, data centers, and digital infrastructure. So a technology fund like XLK has historically had the ability to outpace the broader S&P 500 because it concentrated exposure in a sector that has grown faster than the economy as a whole. But again, there is no free lunch. When you own more technology, you own more volatility, you own more valuation risk. You own more sensitivity to interest rates, investor sentiment, and regulatory change. You also own a sector where winners can become extremely powerful, but where expectations can sometimes run far ahead of reality. The principle is simple. Technology can compound wealth when the cycle favors it. But if you own it without understanding the cycle, you can mistake momentum for safety. That is dangerous. A fund like XLK is not just a better S&P 500. It is a different concentration of risk. If you believe technology will remain one of the dominant engines of productivity, earnings growth, and global economic transformation, then a technology tilt may make sense as part of a portfolio. If you cannot tolerate the drawdowns, then the higher return potential is not useful to you. Because what matters is not what the fund can return in theory. What matters is what you can actually hold in real life. The third area is aerospace and defense, represented by funds like PPA. This one is psychologically different. Many investors prefer not to think about defense companies because the subject makes them uncomfortable. That is understandable. But investing requires looking at the world as it is, not as we wish it were. Defense spending is not purely tied to the consumer cycle. It is tied to geopolitics, national security, government budgets, weapons systems, satellites, cybersecurity, aircraft, missile defense, and long-term contracts. When the world becomes more unstable, governments do not usually decide to spend less on defense, they often spend more. That creates a different kind of economic engine. Aerospace and defense companies can benefit from long contract cycles, government demand, and spending that is less sensitive to whether consumers are buying more shoes or fewer restaurant meals. That does not make the investment morally right or wrong for every person. Each person must make that decision. A good investment must make several kinds of sense. It must make financial sense. There must be a realistic possibility of returns. It must make legal sense. You must be investing within the rules, and it must make moral sense to you, because if you own something that violates your own values, you may not be able to hold it when the environment becomes difficult. That is important. The goal is not to tell every person to own defense stocks. The goal is to understand why a defense ETF can behave differently from the general market and why it has historically been able to outperform during certain periods. The world is not always peaceful. Capital flows toward the systems governments decide they cannot live without. Defense is one of those systems. Whether you want exposure to that is your decision. But you should understand the mechanism. The fourth fund is a momentum fund, such as SPMO. Momentum is the idea that companies already moving strongly may continue to move strongly for a period of time. This is not the same as buying cheap companies. It is almost the opposite. It is buying strength that can feel strange to people who were taught that good investing means only buying what looks inexpensive. But markets are complex systems, and sometimes strength attracts more strength. When earnings are improving, when institutions are buying, when analysts revise expectations higher, when capital flows into a name, the price can continue to rise longer than most people expect. A momentum ETF tries to systematize that behavior. It looks inside the S&P 500 and owns the companies with the strongest momentum characteristics. It is not relying on you to guess the one stock that will keep rising. It creates a basket and rotates based on the rules of the fund. That structure can be powerful. But it comes with a very clear risk. Momentum can reverse. When a crowded winner turns, it can fall quickly. A momentum fund can capture leadership, but it can also be whipsawed when leadership changes. It may buy what has already been working right before the market decides that something else should work next. So again, you must understand the asset. SMO is not a magic machine. It is a rules-based way to follow strength among large companies. If the market rewards strength, it can do very well. If the market punishes crowded trades, it can hurt. That is why position sizing matters. It is why you should never confuse recent performance with guaranteed future performance, and it is why the system you use to buy and hold matters as much as the fund you choose. The fifth fund is SMH. The semiconductor ETF, this is the one that has produced some of the most extraordinary historical numbers because semiconductors became the foundation layer of the modern economy. Chips are not just inside computers anymore. They are inside phones, cars, factories, servers, defense systems, medical devices, artificial intelligence infrastructure, cloud computing platforms, data centers, and nearly every machine that matters. If software is the language of the modern economy, semiconductors are the physical brain and nervous system. That is why the semiconductor industry has become so important. The AI boom did not come from nowhere. It required chips, it required GPUs, it required memory. It required networking, it required advanced manufacturing, it required an entire supply chain that most ordinary investors did not study until the stock prices had already moved. SMH gives exposure to the companies in that ecosystem. Over the last decade, that exposure has been extraordinarily powerful. But I want you to be very careful with the word extraordinary. Extraordinary returns often come with extraordinary expectations. If a sector has already gone up a great deal, that does not mean it must stop. Strong trends can continue for longer than people think, but it also means the market may already be pricing in a very bright future. If the future comes in merely good instead of perfect, the stocks can still fall. That is the paradox. A great industry can be a bad investment if bought at the wrong price or held with the wrong expectations. So the question with semiconductors is not simply, is AI real? I think the answer is yes. The question is, how much of that reality is already priced in, and can you tolerate the volatility while the cycle unfolds? If your answer is yes, a semiconductor ETF may offer a way to participate without trying to pick the single winner. That is the point of the basket. You do not need to know exactly which company will dominate the next part of the cycle. You can own exposure to the infrastructure that many winners need, but you still need humility because every cycle creates both wealth and overconfidence. And overconfidence is one of the most expensive emotions in investing. Now, there is a broad bonus fund many people think about, and that is QQQ. QQ gives exposure to the Nasdaq-100, which is made up of 100 of the largest non-financial companies listed on the Nasdaq. In practice, that means it has a heavy technology and growth tilt. But it is not exactly the same as a pure technology fund. It owns many large, dominant businesses that have shaped the last 2 decades of market performance. This is why QQQ has historically outperformed the S&P 500 over many periods. But the reason it outperformed is the same reason it can be painful to own. It is more concentrated. It is more growth-oriented. It is more volatile. When the market wants innovation and growth, it can run very hard. When the market wants safety and cash flows, it can fall harder than the S&P 500. That is not a flaw. That is the nature of the exposure. Every portfolio decision is an exchange. You exchange stability for upside. You exchange diversification for concentration. You exchange comfort for the possibility of better compounding. The mistake is thinking you can get all of the upside without any of the discomfort. You cannot. That is where many investors fail. They buy a higher returning ETF because they like the chart. But they do not prepare themselves for the drawdown. They do not ask what the fund owns. They do not understand why it went up. They do not understand when it may underperform. Then, when the inevitable decline happens, they panic and sell. That is how a good asset becomes a bad personal result. The asset did not fail. The system failed. So let us talk about the system. If you are going to own ETFs like these, especially funds that attempt to outperform the S&P 500, you need a process that removes as much emotion as possible. The process is simple in words but difficult in practice. Always be buying. That does not mean be reckless. It does not mean invest money you need for rent, food, emergency reserves, or short-term obligations. It means that once your financial foundation is in place and you have decided on a long-term allocation, you create a system where money moves into the market consistently every week, every 2 weeks, every month. The timing should not depend on whether the headlines feel good. It should not depend on whether a Republican or Democrat is in the White House. It should not depend on whether oil is up or down this week. It should not depend on whether one economist thinks a recession is coming. If you believe in the long-term asset, and if it fits your risk capacity, then consistency is your edge. Most people do the opposite. They wait for confidence. By the time they feel confident, the asset is often more expensive. Then, when the market falls and better prices appear, they feel fear. They stop buying, some sell. They turn volatility from an opportunity into a wound. That is backwards. If you believe you own a good asset, a decline is not automatically a reason to leave. It may be a reason to buy more. That is the second part of the system. Buy the dip. Again, this does not mean buying every falling knife blindly. It means having a prepared plan for market declines before they happen, because they will happen. The market has had many recessions. It has had many crashes. It will have more. That is not a prediction. That is the nature of the economic machine. The economy expands. Credit grows. Confidence rises, prices rise, then excess builds, something breaks, prices fall, weak hands leave, stronger buyers step in, the system resets, the cycle begins again. This is how markets work. The person who is surprised by every downturn is not studying history. In 2022, when the stock market fell sharply, good assets went on sale. In 2020, when the market fell very quickly, good assets went on sale. In 2008, when the financial system looked like it was breaking, good assets went on sale at extreme discounts. The problem was not that opportunity did not exist. The problem was that most people had no cash, no plan, and no emotional discipline. So they could not act. The market creates millionaires in downturns, but only for people who prepared before the downturn. You cannot improvise courage in the middle of panic. You build it in advance through rules. That is why cash reserves matter, not because cash is the best long-term asset. It is not inflation slowly destroys it. But cash is optionality. It gives you the ability to buy when others are forced to sell. It keeps you from selling good assets to cover short-term needs. It gives your investment system the oxygen it needs to survive stress. A person who invests every dollar and keeps no reserve may look smart during a bull market. But when life hits at the same time the market falls, that person can be forced to sell at the worst moment. That is not investing, that is fragility. So the real strategy is not simply buy VUG, XLK, PPA, SPMO, SMH, or QQQ. That is not enough. The real strategy is to build a system around the assets. You need a core. For many people, that may still be the SP 500. Do not underestimate it. It is one of the greatest wealth-building tools ordinary investors have ever had. Then if you understand the risks and believe in the underlying forces, you can add satellite exposures around that core growth technology. Defense and aerospace, momentum, semiconductors, Nasdaq 100, each satellite should have a reason, not a story you heard once, not a chart that went up, not a fear of missing out, a reason growth, because you believe earnings expansion and innovation will continue to be rewarded over decades, technology because you believe digital infrastructure remains central to the economy, defense and aerospace because you believe geopolitical risk and national security spending remain persistent forces. Momentum because you believe systematic exposure to strong large-cap trends can capture leadership. Semiconductors because you believe computing, AI, automation, data centers, vehicles, robotics, and defense all need more chips. QQQ because you want broad exposure to large, innovative, non-financial companies with a technology-heavy tilt. That is how a rational investor thinks, not in predictions. In exposures, what am I exposed to? What risk am I being paid to take? What environment helps this? What environment hurts it? Can I hold it through the bad part? What percentage of my portfolio should it be so I do not destroy myself if I am wrong? Those questions matter more than the ticker, because the ticker is only a vehicle. The real asset is the system of thought behind it. Now, I want to make something very clear. Past performance does not guarantee future performance. This sentence is repeated so often that most people ignore it, but it is one of the most important truths in investing. A fund that returned 18% or 21% or 33% in the past may return much less in the future. It may underperform for years. It may go through brutal drawdowns. It may be replaced by a different leader in the next cycle. That is why you do not bet your whole future on one idea. The market has a way of punishing people who confuse a good thesis with certainty. I have seen many people do this. They see a sector that worked. They put too much money into it. Then the cycle turns, and they learn that concentration without understanding is not conviction. It is leverage in disguise. So if you decide to seek returns above the SP 500, do it carefully. Use sizing. Use diversification, use automatic buying, use cash reserves, use a long-term lens, use humility. The goal is not to beat the market every month. The goal is to create a structure that may improve your long-term compounding without making your emotional life so unstable that you abandon the structure at the wrong time. That is the art. Anyone can look at a chart after the fact and say, I should have bought that. Very few people can buy systematically before the outcome is clear. Hold through a decline and keep buying when the news is ugly. But that is usually where the money is made, not in certainty, in disciplined uncertainty. Think about what the SP 500 itself teaches us. It has averaged strong returns, not because every year was easy, but because productive companies adapt, grow earnings, replace weaker companies, and compound value through time. The investor who benefits is not the one who avoids every decline. It is the one who survives every decline and stays in the game long enough for the compounding to do the work. The same principle applies to these other ETFs if you own them. You must own them as part of a long game. Do not buy XLK because technology is exciting this month. Buy it only if you believe technology remains structurally important over many years. Do not buy SMH because AI is in the headlines. Buy it only if you understand semiconductors as a foundational layer of modern productivity and accept that the sector can be brutally cyclical. Do not buy PPA because there is one conflict in the news. Buy it only if you understand defense spending as a persistent part of the global system and if it fits your moral framework. Do not buy SBO because it went up. Buy it only if you understand how momentum works and how it can reverse. Do not buy QQQ because you missed the last decade. Buy it only if you are willing to hold a more volatile, growth-heavy basket through both melt-ups and crashes. That is the difference between chasing and allocating. Chasing is emotional. Allocating is systematic. One of the best ways to know whether you are chasing is to ask yourself a simple question. If this fund fell 35% over the next year, would I buy more, hold, or panic? If the honest answer is panic, the position is too big, or the fund does not belong in your portfolio, that is not weakness. That is information. Risk management begins with honesty. Many people pretend they can handle volatility because they want the higher return. Then the volatility arrives and they discover they were borrowing confidence from a bull market. Do not do that. Design the portfolio for the person you really are, not the person you imagine yourself to be on a perfect day. If you do that, the whole system becomes more durable. And durability matters because the compounding advantage from slightly better returns only appears if you stay invested long enough to let it appear. Remember the first example over 10 years, the difference between 10% and 13% is meaningful over 30 years. It is enormous. That means the game is not really about finding the fund with the highest one-year return. The game is about finding a structure you can hold for 30 years. That is much harder. A 30-year strategy must survive recessions, job losses, political shocks, inflation, deflation scares, oil shocks, wars, bear markets, bubbles, bad headlines, and your own changing emotions. That is why the system must be simple enough to keep using. Complexity often feels intelligent, but it can be fragile. A simple core, a few deliberate tilts, automatic buying, cash reserves, and a rule to buy more during big declines may be more powerful than an elaborate strategy you cannot maintain. The discipline is what creates the result. Let me bring this together. The S&P 500 is still a great foundation. Trying to beat it is not necessary for every investor. Many people would do better simply buying the S&P 500 consistently, avoiding debt, keeping expenses low, and never panic selling. But for investors who understand risk, who have the emotional discipline, and who want to consider ways to seek slightly better long-term returns, certain ETFs have historically shown the power of focused exposure. VUG for growth, XLK for technology, PPA for aerospace and defense, SBMO for momentum, SMH for semiconductors, QQQ for the Nasdaq 100. These are not secrets. They are public tools. The difference is not access. The difference is understanding. Most people have access to the same funds, the same data, the same accounts, and the same ability to set up automatic investments, but they do not have the same behavior. Behavior is the real edge. The market does not reward the person who knows the most tickers. It rewards the person who can make a good plan and keep following it when the plan is emotionally uncomfortable. That is why I always come back to principles. Know what you own. Know why you own it. Know what could make it underperform. Know how much you can afford to allocate. Keep buying if the long-term reason is still valid. Buy more when fear creates discounts, but only with money you can truly afford to commit. Do not sell because the crowd is panicking. Do not buy because the crowd is euphoric. And never confuse a rising price with a sound decision. If you follow that discipline, you do not need to be brilliant. You do not need to predict every move by the Federal Reserve. You do not need to know who will win the next election. You do not need to guess the exact month of the next recession. You need a system that survives all of those things. The S&P 500 has created wealth because the productive economy kept moving forward despite repeated crises. Some focused ETFs may do even better if the forces behind them continue. But the most important thing is not the fund. It is whether you can stay rational long enough for compounding to matter. Because compounding is not just mathematics. It is character over time. It is the reward for patience, discipline, humility, and the ability to act when your emotions are telling you to do the wrong thing. That is why slightly better returns matter so much. Not because they make you rich overnight, because when combined with time and discipline, they can quietly pull your future forward by years. And in the end, that is the real purpose of investing. Not to impress strangers, not to win arguments online, not to chase the hottest fund. The purpose is to buy yourself more freedom, more optionality, more control over your time, and more resilience against a world that will always be uncertain. If you can use ETFs intelligently to do that, then you are not just investing, you are building a system that works while you live your life. And that, in my view, is the point.